Kia ora everyone, welcome back to our next edition of Econ Talks. Gareth, we've had the Reserve Bank follow up their 50 basis point increase to the official cash rate in April with a further 50 basis point increase, the first time that's happened, and probably more importantly, a much stronger view from the Reserve Bank that they are going to be what they call resolute to try and get inflation under control, and are moving briskly, as they put it, to increase the official cash rate to really start to put the brakes on inflation and squeeze down what is a huge amount of pressure that we're seeing in the economy. There was quite a lot to unpack in the latest monetary policy statement from the Reserve Bank, but like I say, that immediate increase coming forward, a really rapid increase in terms of their forward expectations of the official cash rate, and really that feeling that after coming through in February with their latest forecast track and saying, actually, we're happy to wait it out. We think that we do need to raise the official cash rate, but we're happier to do it in 2023. No real changes needed in 2022. That position completely flipped now. A huge amount of front loading of the official cash rate now coming on. The bank thinking that the sooner you try and get inflation under control, the better. Now, we've seen that the Reserve Bank's got a particularly substantially higher peak official cash rate expectation. Are we actually like to get there?
It's interesting. There's a lot of sort of signalling coming through from the Reserve Bank, both in terms of the language they've used, and you referenced some of that, but also I think the forecast track on the OCR pushing up towards 4%. Look, it's possible given some of the inflationary pressures we're seeing at the moment, and certainly if you look at Treasury's forecasts for inflation, they weren't particularly confident the Reserve Bank was going to be getting inflation under control anytime soon. So it makes sense the Reserve Bank is coming out with a stronger path. Whether they actually need to do it or whether the signalling sort of becomes a little bit self-fulfilling is another question. So, I mean, yeah, we're thinking possibly, you know, the OCR, we had 3.25 for a peak, pushing higher than that, maybe 3.5. We'll hold our judgment on 4% at this stage. It does really depend on just how sustained some of those inflationary pressures are. Particularly, I mean, look, it's going to keep going in the global economy in terms of some of those supply chain disruptions and the cost pressures that are coming through there. But what the Reserve Bank is really trying to get on top of now, I think, is some of those domestic pressures which they've previously been quite relaxed about, and particularly referencing, of course, the labour market. They're at pains to say there that the labour market is operating well beyond maximum sustainable employment. So both the indicators they've finally come to recognise are, you know, outside their mandate, and they need to do something a bit more vigorous to bring them under control.
Absolutely, and look, our forecast expectations going forward are actually for 2 more 50 basis point increases back to back of that view again as the Reserve Bank is, and really they've come around to the position that we've been pushing quite hard in recent times, that if you think you know where your end goal is, realistically the sooner you get there the better. And very much like you say, maybe they don't need to go quite as high as the 3.95, the 4% they're sort of expecting, but I think as well the signalling this time is that you would be an idiot to try and second guess the Reserve Bank on that number, because they've shown to be a lot more forthright, a lot more assertive and aggressive when it comes to trying to do things. The tone of the statement was quite what a lot of people are calling hawkish. Really, I think it's just realistic, right? You've got inflation which is outside the target band, you've got an incredibly stretched labour market, and even then I think the bank could be still too heroic in its expectations that inflation magically comes under control within the next 2 years. Now the Treasury rather, pushing their expectations out into 2025 might be a bit too long if you do see sort of a much more rapid set of increases coming through from the Reserve Bank, but really that's sort of putting everyone on notice, right, that there is more to come. Realistically, though, we're not likely to see probably the same pass through into retail rates. Retail rates already having moved up quite a bit. Before the official cash rate announcement through in May, the Reserve Bank had increased the official cash rate by 1.25 percentage points over the same, and that's over the last year. Over that same 12-month period, the 2-year mortgage rate had increased by 2.51 percentage points. So a much larger shift. And what does this mean in terms of rates, Gareth? Are we going to see those sort of higher, much higher mortgage rates, and what does that mean for housing?
I guess if financial markets believe the Reserve Bank is going to be pushing the OCR to 4 rather than 3.25 as they previously signalled, then that does have to get priced into higher expectations in terms of some of those fixed rates. You talk about it being priced in already. Well, the expectation of 3.25 was, but maybe not the expectation of 4. So our expectation would be, if that's where the Reserve Bank is headed, then you're getting your 2-year mortgage rate up over 6% from where it is now, and your 1-year rate could be heading close to that by late this year or into early 2023 as well. So not a full pass-through of what's yet to come, but there is still upward pressure there on those rates. Of course, the risk then becomes for mortgage holders. They start to look at some of the longer terms and think, well, are they more attractive? And that's when you get to the position, sort of the peak of the cycle for some people, that they go and fix for 5 years and then interest rates are heading in the other direction. That can be a regrettable decision sometimes, and we've seen that in previous cycles. For the housing market, well, yeah, look, we're, I guess, nervous, uncomfortable about where the housing market is going at the moment. Our forecast is for house prices to fall 5% this year and sort of 8 to 9% in total through to 2024. But the expectation, given where rates are going, is that pressure is still building to push house prices down further. And certainly there seems to be an expectation or a feeling in the market that the prices last year were not sustainable, either from a buyer's point of view, once you get mortgage rates rising, but even sellers are looking and going, yeah, we're comfortable with the price that's down 10 or 15% on what we might have got in the middle of last year, because we just thought that was ridiculous too. So there is still a room for those house prices to come off, even though we're looking at an economy that has been performing strongly, and particularly that labour market situation, which is very tight. Normally you'd look at job losses and go, that's the catalyst for house prices to fall. But this time interest rate sensitivity does seem to be a lot greater.
I mean, it's interesting as well, right? It's been, now 2 days since we've seen the Reserve Bank make that announcement, and no changes coming through from the banks yet. So I think everyone taken a little bit, by surprise by the strength of the tone from the Reserve Bank. Realistically, though, some of the other forecasts sort of not formally forecasting a hard landing, trying desperately to come in with that soft landing of bringing down demand to meet where supply can actually achieve, economic activity without inflating prices quite as much. Is that realistic? Surely by playing catch up and having to be a lot more aggressive and assertive with interest rate rises, the risk essentially of overcooking it is heightened with every step.
Yeah, I mean, Adrian Orr did say, was at pains to say the Reserve Bank is not forecasting a recession, which is technically true because you need negative quarters of growth for that. But you look at their GDP growth forecast out from 2024 onwards, you're talking about 0.1 or 0.2% growth per quarter. And that is a pretty pitiful performance, especially when it's extended over the course of a couple of years. The growth numbers do look very soft out there. And I do think it's a reflection of the fact that because they were slow to start raising rates last year, and now they're having to play catch up and go a lot faster, that it does have repercussions for economic growth over the medium term. They're obviously pessimistic in terms of the economy's ability to grow without, much growth in the sort of labour force as well, and net migration, working age population being pretty slow. So it is quite a sobering picture when you look at what the Reserve Bank is now predicting for the next 2 to 3 years.
Absolutely. I mean, a lot of water still to go under the bridge. Really, the next few months will be critical for not only how quickly the Reserve Bank can continue to raise rates, but also what sort of effect they might see in the wider economy. Do you see that sort of strength of the New Zealand economy soften back? Do you see the likes of interest rates have, like we've been talking about, an even stronger influence on the housing market? And does inflation go higher and then start to pull back, or does it hold at that much higher level for longer than we'd all be comfortable with? We'll assess that and everything else in the economy and how the Reserve Bank's actions will influence outcomes on one of our future editions of Econ Talks.